Hey guys, Tyler Jeffcoat here one more time from Seller Accountant, and we've been having a discussion about how SKU level profitability might impact your financing strategy, might impact your cost of capital strategy. And so here's the payoff video here. So the first video we talked about defining profit. The second video we talked about kind of getting in the weeds and understanding SKU level profitability, whether you're doing it manually using the fee preview report from Amazon or whether you're using a great dashboarding tool. What I want to do in this video today is let's take this conversation a step further. I'm going to use a couple of examples on the screen here to illustrate that it can't just be about profitability. We need to start thinking in terms of, if I put $1 of capital into my business, what do I get back? And so let me walk you through this. If you guys can see the screen, I've got my first product is called a good product. This is actually an extremely good product. This product, after advertising, after cost of good, after logistics, is a 30% net profit or PAG product, post-advertising gross profit. That's extremely good. What's even better about this product is because we have a fairly low cost of goods sold ratio, our ROI on this product is actually 107%. So what that means is the profit that we bring in is more than so actually the way I had done the math here, by the way, is if I have a 30% profit margin divided by, I only have 28% in my cost of goods sold, my landed COGS, the product itself, then I have 107% return on my inventory investment. ROII is return on inventory investment. I place $1 into buying inventory, and when that inventory turns and I get my dollar back, I now have that dollar plus $1.07. I've made $1.07 in profit. That's a pretty strong profit picture for this product. Now, the final thing that really determines how much I love my products and how I should view them when I'm looking to raise cash is how many times I can turn that dollar each year. So if I have the example I'm giving you here is, this is a really good product. This is an extremely profitable product. And don't get me wrong, I'm going to be happy with either of these, but I can only turn it a little less than twice a year. That means I'm having to place big orders and they sit on the shelf, they sit in the warehouse for a while, and I'm only able to turn that inventory and get paid less than twice a year, which means I have to have a lot of money in my balance sheet or in my warehouse in order to run this business. So if I compare that to a product that's slightly less profitable, in fact, 19% is way less profitable, and I'm spending quite a bit more securing the actual, in fact, this is the same 28% cost of goods sold. So now I take my 19% net profit divided by the 28% that I had to spend to secure the product, and you can see that's why I got 68% return on inventory investment, much lower, then it's only 2/3 of what the ROI is here for the good product. But the fast product wins in this situation because I can take that same dollar, and instead of turning that dollar less than twice a year, I can turn it 4 times a year. Every quarter, I can take that same dollar, invest it again, buy more product, buy more product, buy more product. And so if I multiply that ROII, that return on inventory investment, by the number of times per annum, per year, that I can take that cash and create profit from it, what I see here is, oh my gosh, I never would have guessed this, but I would actually, over the course of a year, prefer the second higher velocity product to the first more profitable product. Now, to be clear, if you're this seller, you're going to keep both of these because these are both very lucrative products. But let's look at what happens if you have some bad products. So here's another picture here where this row 3 here that says average product, this is pretty close to what I'm seeing across the board as kind of an average Amazon seller, where you got 20 to 25% PAG, post-advertising gross profit. You've got about 60% ROII, which is return on inventory investment. The way I came up with that math, by the way, is that most of our sellers have about 33% of their total budget that's landed cost of goods sold. So you think about, it's not counting logistics, not counting Amazon fees, just the COGS. The landed COGS is about 33%. Makes sense. You buy a product for $1, you triple it, you try to sell it for $3. And so if I take that 33% and divide it by it's the opposite, the 20% net profit, and divide it by the 33% I had to pay to secure the product, I've got a little over 60% ROII, return on inventory investment. Now, the average seller is somewhere in the neighborhood of 3 turns per year. So not quite every quarter, although some sellers are better. They're getting it closer to 4 times a year. That would be ideal. And as a result, the annualized ROI is about 180%. So here's what that means in like layman's, not ridiculous spreadsheet terminology. If I have $1 at my disposal for working capital in this average seller example here, I'm going to end the year having gotten my dollar back plus $1.80. That's pretty nice. Over the course of the year, I'm going to pretty close to triple my money. Now, this is before other expenses and taxes and salaries and software and accounting and everything else. But this is the metric that we have to keep an eye on that will determine how we can fund everything else. Let me show you one more thing real quick. This is not just resellers, but this would be a pretty classic example where if I'm a reseller where I have fairly low profit margins, and now all of a sudden I've got closer to 50% of my budget. I'm not advertising so much, but I'm having to buy product at a fairly low return on investment, only 34%. Now with that same 3 turns per year, I'm not nearly as happy. In fact, I'm almost half as happy as I was with the other product. This gets really, really bad if I have a slow turn where I'm having to hold on to a lot of inventory, either as a retailer, a reseller, or as a private label branding person, because here's what happens. If I'm and this is, by the way, where I'm pivoting hard into finance and raising cash. If I'm in a position where over the course of a year, my product only makes me a 51% return on that investment of inventory over the course of a year, and I get one of these, let's call them kind of advances or payday lending kind of partners that are charging, if you annualize out those interest rates, they're charging like 35 to 40% sometimes. I am dead in the water because my products at best are giving me 50 points that I can then turn around and over the course of the year use it to pay my salaries and pay my software expenses and all these other things that are not directly connected to my portfolio. And I'm going to turn around and pay, of that 50 points, I'm going to pay 40 of them to the lender. I'm never going to be able to scale enough to be profitable, to pay taxes, to do all the things I have to do in scale. And so in a picture, and again, this is kind of anecdotal. At the end of the day, you're going to look at your products, you're going to identify the ones that are best performing, and you're going to focus as much of your capital and your energy into those products as you can. And if all of your products are bad, if you could understand how many turns per year you have in a given product, what your actual return on inventory investment is, and you could calculate, I'm just literally multiplying ROII times turns, what I realize is, oh gosh, I've got a loser here. I've got a really low margin. I'm in trouble because my interest expense, if you were to annualize it, is actually close to 30 points. I need to dump this product. This product is not scalable. I should not take any debt. This is the punchline here. Do not get a loan to take on debt that is expensive enough that you can't make way more profit than the expense of the interest. It is better to grow slowly, to stock out, to wait to get that cash back, or better yet, to find products that are more profitable and move more quickly than it is to have low profit combined with slow moving products and to pour on the fuel of bad debt. Because normally when you're not profitable, you're stuck with getting not the greatest kind of debt for your balance sheet. And so you end up in kind of a death spiral where you might be able to continue building volume. I have more sales, but there's a fundamental challenge to my business model. The other thing that I would mention here is I've never met a reseller who doesn't also have a lot of overhead, right? In order to get that product purchased and repackaged or bundled or kitted, or to pay my person to go to the store, or to pay my listing team to find the opportunity, there tends to be a fairly high overhead factor for these sellers, which means my minimum acceptable annualized ROI is going to be even higher to make this a good business model for me. Again, a dream situation, kind of back to this first tab, is to have products that generate great profit margin, great return on inventory investment, and turn enough times per year, or are a fairly fast moving product. A lot of this has to do, inventory terms has a lot to do with managing inventory well. Do I understand where my inventory is? Can I renegotiate my supply chain terms to not pay everything quite right away? Can I wait and not have too much inventory in the warehouse, but also not stock out, kind of juggling those two extremes? And can I build a turn per year kind of picture that is high enough that I'm getting the desired ROI on my investment? investment. So that's a mouthful. There's a lot there. My biggest takeaway for you is don't get on debt. Don't take on bad debt if you have unprofitable products or products that don't move very quickly. And the second thing is make sure that you don't just stop at a profitability metric. PAG, I love PAG. I talk about PAG all the time. It can't be where I stop. I have to then think about, okay, if I'm going to have $1 that I put into my business system as a token, what am I going to expect to get out? How many times per year am I going to expect that dollar to come back out? And what is my ultimate smiley face or frowny face at the end of the year? I hope that's helpful, guys. And thanks again for joining us for this series on connecting SKU profitability with capital raising and debt funding. Just know that the more profitable you are and the quicker you can move inventory, the better your options are in terms of raising capital. Take care.